Hello and welcome back to another deep dive. It is really great to have you with us today.
Hey, yeah, great to be here.
So, we're taking a little bit of a step back from the frenzy today. We are sitting here in early 2026, and if you look at the financial headlines, it's all about the next quantum leap.
Right, the next AI breakthrough, the shiny new tech.
Exactly, the really fast-moving parts of the market, and honestly,
It can be exhausting.
it really can be. The fear of missing out, the FOMO, is just at an all-time high right now.
It is. People are chasing growth at any cost.
But today, we are going to pivot entirely. We're looking at a stack of research that is, frankly, a little bit boring. And I do mean that as a massive compliment.
Boring is beautiful,
Hmm.
especially when it comes to compounding.
Yes, exactly. So we're working off this really fascinating analysis from WealthForge Investing. It's a breakdown hosted by Nick over there.
Right, their recent report.
Yeah, and the headline is Dividend Value Watch, but the subtext of the whole thing is really about crafting a stronger financial future by finding these diamonds in the rough.
Hmm.
Undervalued, dividend-paying shares.
4 specific powerhouses for 2026, to be exact.
Right, for massive names. But before we can actually unpack those companies, we have a very important piece of business to attend to. We have to eat our vegetables.
We do. And we want to be clear, this isn't just the fine print you skip over. This is really the crucial context for the entire conversation we're about to have.
Right, so we are going to read this fully and clearly because it is mandatory for everyone listening to understand the boundaries here.
Absolutely. So let's be crystal clear right up front. The content we are discussing today, which is derived from the WealthForge investing analysis, is provided for informational and educational purposes only.
That is the absolute key phrase, informational and educational. It should not be considered financial, investment, or tax advice.
Correct. We're not licensed financial advisors.
No, we are not.
And the source material explicitly states that they are not licensed financial advisors either.
Meaning that absolutely nothing we say in this deep dive constitutes a recommendation to buy, sell, or hold any security.
Precisely. If you are an investor, you must conduct your own research. You really need to look at your own unique financial situation and, consult with a qualified financial professional before making any investment decision.
Okay. Disclaimer delivered, we're responsible, we're clear.
Vegetables eaten.
Exactly. Now let's get to the actual strategy. Because what I really love about this particular deep dive is the mission behind it.
Yeah, the framework.
Right. We aren't just looking at random stocks that happen to have high yields. We're hunting for a very specific setup.
We are. And the WealthForge source makes a really important distinction right off the bat. This isn't about finding what they call distressed value.
Okay, let's pause on that. Let's define that. Because when I hear value investing in 2026, I often just immediately think of companies that are beaten down because they're, well, broken. Like the business model is actively failing.
Right, and that is distressed value. That's what people call catching a falling knife.
Because it just keeps dropping.
Exactly. It's super high risk because the company might actually be collapsing. But the theme here is completely different. The analysis defines it as income-supported re-rating potential.
Okay. Income-supported re-rating potential. That is a serious mouthful. Can you unpack that for the listener who might not be fluent in dense finance speak?
For sure. Think of it as a 2-engine airplane.
Okay.
Engine 1 is the re-rating part. So you're looking for a really solid company where the market has perhaps just cooled on the price.
Like the valuation has compressed.
Exactly. It's just out of style right now.
So it's like a perfectly good house, but it's in a neighborhood that isn't trendy at the moment.
That's a great way to put it. You buy it, hoping the broader market eventually wakes up and realizes, hey, wait a minute, this is actually worth a lot more.
And that sends the stock price up.
Right. That's the re-rating. The market changes its rating of the stock's value.
But waiting for the market to change its mind, that can take a really long time.
It can take years. And that is exactly where Engine 2 comes in. The income support.
The dividends.
Exactly. While you wait for that re-rating, the company pays you a solid, reliable dividend. You are quite literally being paid to wait.
ISO. So if the stock price just stays completely flat for 2 years, you haven't wasted your time because you've been collecting actual cash checks the whole way through.
Precisely. It lowers the psychological barrier to holding the stock. It's not just gambling on a chart going up tomorrow. It's much more like gardening.
Gardening.
Yeah, you plant the seed, you water it with the dividends you collect, and you just wait for the seasons to change.
I love that analogy. Gardening definitely beats gambling every time. So the four companies WealthForge identified for 2026, they fit this specific mold perfectly.
They do.
Let's jump into the first one then. We're starting with a real heavyweight in the energy sector. Enbridge, ticker symbol ENB.
The infrastructure giant.
Now, for those who don't follow the actual plumbing of the energy world, Enbridge is a major North American energy infrastructure operator.
Right. They literally move the oil and gas that powers the economy.
Yeah.
They have the pipelines.
Right. And looking at the data for early 2026 from the report, the shares have been trading in a pretty specific range.
Roughly between $48 and $54.
So it's not bouncing off the ceiling,
No.
but it's not crashing through the floor either. It's just steady. But here is where that income-supported part of our theme really kicks in. Let's talk about the dividend for Enbridge.
It's significant. The company increased its quarterly dividend to approximately 97 cents per share.
Okay, let's do the napkin math on that real quick. So 97 cents a quarter,
That totals about $3.80 annually per share.
which is substantial. But, and this is a big but, high yields can sometimes be a trap, right?
Oh, absolutely. The classic yield trap.
Right, because if a company pays a really high dividend, but the underlying business is crumbling, eventually that dividend gets cut, and then the stock tanks even more. Is that concern here with Enbridge?
The source analysis suggests strongly otherwise. They point to a multi-decade record of consistent dividend payments.
Multi-decade.
Yes. And that speaks directly to reliability. In the world of income investing, consistency is king. You want to know that the check is in the mail, regardless of what the broader economy is doing.
But why now? I mean, why is Enbridge specifically a powerhouse for 2026? Is it just because of the historical dividend?
No, it's about the forward outlook.
Right.
Management is expecting stronger core earnings in 2026.
And what's driving that? Is it just the price of oil going up?
Actually, no. And that's a super key point. Enbridge is infrastructure. They are the toll road.
Right.
They charge by volume, largely. They don't care as much about the price of the commodity itself, just that it's moving through their pipes.
So what's driving the 2026 earnings then?
New infrastructure projects coming online.
Ah, so the toll road is getting wider. They're adding more lanes.
In a sense, yes. See, that's the beauty of this business model. It's incredibly capital intensive to build the pipes and the systems in the first place. I mean, you spend billions digging ditches and laying steel, but once they're online, they generate massive cash with relatively low maintenance costs.
Okay, so how should the listener categorize this holding in their head?
Frame it as a regulated, cash flow-driven business. Because it is regulated, there's a certain floor to the volatility. It is not a wild tech startup.
Right.
The value proposition here is very clear. Investors are largely compensated through that yield, that 3.88 we mentioned, while they wait for those new projects to fully pay off and drive up the earnings and eventually the stock price.
It's the bedrock of the portfolio. It's not going to make you rich overnight, but it definitely helps you sleep at night.
Exactly. It's the anchor.
Okay, let's pivot. We are leaving the oil fields and going to a sector that feels equally essential, but just totally different. Let's talk about the defensive healthcare play.
UnitedHealth Group, ticker UNH.
Now, this one is super interesting to me because of the price action they mentioned. The source talks about a repricing from 2025 levels.
Which is a very polite financial way of saying the stock went down.
Right. A repricing. It says the stock has been trading below $300, with some activity even down in the mid-200s. Now, for a company this size, a blue chip like UnitedHealth, that feels like a really significant discount.
It is.
But usually when a stock drops that much, my alarm bells start ringing. Why shouldn't we be worried here?
That's the central question for UnitedHealth right now. But the analysis here argues that the decline is actually the opportunity. It has drawn attention precisely because the underlying business remains fundamentally strong.
So the market sentiment changed, people got spooked, but the actual business didn't break.
Exactly.
Oh.
It is supported by recurring healthcare revenue. Think about it. People don't stop needing healthcare or health insurance just because the stock market fluctuates or interest rates change.
Yeah.
You might cancel your streaming service if money gets tight, but you don't cancel your health insurance. That revenue stream is incredibly sticky.
Which brings us back to the dividend part of the equation. If the price is down, usually that means the dividend yield looks a lot better. What are we seeing there?
The most recent quarterly dividend was about $2.21 per share.
Okay, so annualized. That's
Roughly $8.70.
Wow. That is a hefty payout.
It is. And again, look at the track record. The source marks this as 15 consecutive years of dividend growth. Not just payments, but actual growth.
15 years. That covers the pandemic, all the regulatory changes, multiple elections, and they just kept raising the dividend through all of it.
Correct. And that is the defensive nature of this pick. You're buying a massive company with a strong recurring revenue model at a price that is significantly lower than it was in 2025. It's a classic value play.
It's almost a contrarian play, really. You're buying when others have sold off, assuming the market has just completely overreacted.
That is the essence of value investing. You're betting that the market's mood swing is temporary, but the business's fundamental strength is permanent.
Okay, I like that. Let's stay in the medical world for our third powerhouse, but we're going to shift gears slightly. We're going from insurance and healthcare services over to big pharma.
Right. Pfizer, ticker PFE.
Now, everyone knows Pfizer, but the context for 2026 is really specific according to the report. Where does the company sit right now?
Well, in early 2026, the shares are trading around $26 to $27.
Just $26 or $27. That feels manageable. I mean, compared to UnitedHealth, that's a very low entry price per share.
It is. But the narrative here is different. This isn't just a stable business that got a little cheaper like UNH. This is a transition story.
Transitioning from what?
From the pandemic era. We all know Pfizer had massive, totally unprecedented revenues during the height of the pandemic.
Right, the vaccines and treatments, they were making billions.
Exactly.
Yeah.
But you can't rely on that forever. The source explicitly mentions they are moving away from those pandemic-era revenues. They're normalizing.
So they're trying to find the new normal.
Right. They are focusing on rebuilding growth through its pipeline.
Okay, pipeline. That is the absolute magic word in pharma. Can you explain why that matters so much to an investor looking at Pfizer?
Sure. In the tech world, you look at the next software update or hardware release. In pharma, you look at the pipeline, the drugs that are currently in clinical trials. A pharmaceutical company is really only as good as the drugs it will be selling 5 years from now.
Because patents on the old blockbuster drugs expire.
Exactly, the patent cliff. So Pfizer is in a period right now where they are investing heavily in that future.
But the payoff for those investments isn't fully visible yet.
Right. Trials take time.
Yeah.
And that creates uncertainty in the market, which depresses the stock price. But while those bets are maturing, you have the income stability.
Let's talk about that income. What is the payout for Pfizer?
They're paying a quarterly dividend of 43 cents per share.
So modest, but steady.
Right. And the source frames this perfectly. It provides income stability during the transition. You are getting paid while the company reinvents itself for the post-pandemic world.
And what does the actual outlook look like for 2026? Is there light at the end of the tunnel for those earnings?
Guidance suggests 2026 earnings will be in the range of approximately $2.80 to $3 per share.
Okay, so if we compare this to UnitedHealth. UnitedHealth was a story about a strong, steady business that got cheaper. Pfizer feels much more like a rebuilding story.
That is a really great distinction. UnitedHealth is a defensive play. Pfizer is a turnaround play. You are betting that the pipeline will eventually deliver, and that 43-cent quarterly dividend is your safety net while you wait.
I love how these are different flavors of value. It really shows that dividend investing isn't just one monolithic thing.
It really isn't. You have infrastructure, defense, and turnarounds.
Which brings us perfectly to our fourth and final powerhouse from WealthForge. And this one seems to be bucking the trend entirely. We're going back to the energy sector, but specifically services.
SLB, formerly known as Schlumberger.
Right, the global oil field services provider. Now, with Enbridge, we had a solid, steady trading range. With UnitedHealth and Pfizer, we talked about prices coming down or stabilizing after a drop. But SLB.
SLB is different. The shares have recently traded around $50 to $51.
And the source notes that is actually near their 52-week highs.
Right. So this is not a buy-the-dip situation in the traditional sense. This is a momentum play.
But wait, why is it trading so high? And if the others are value plays because they are technically undervalued, why is SLB on this list of powerhouses?
Because of the macroeconomic driver behind it. The price reflects improving demand for production services.
Meaning oil companies are out there drilling more.
Or at least they're investing more in their existing infrastructure and efficiency. The source puts it as, quote, global energy investment stabilizes.
Okay, so when the massive energy companies, the Exxons, the Chevrons of the world, when they decide to spend money, they hire SLB to do the actual work.
Exactly. SLB provides the technology and services.
So SLB sells the picks and shovels for the energy gold rush.
That's the perfect way to look at it. And because that global demand is stabilizing and improving, the stock is performing really well.
And despite being near its recent highs, it's still considered a strong dividend play.
It is. SLB returns capital through regular quarterly
Hmm.
dividends. And interestingly, the source notes, these are tied specifically to operating cash flow.
Oh, that's interesting. Can you explain the significance of that? What does it mean for a dividend to be tied to operating cash flow?
It means the dividend isn't just some fixed arbitrary number that a board of directors decided on 5 years ago and refuses to change. It aligns the shareholder returns directly with the actual real-time health of the operations.
Okay.
If the business booms and cash flow surges because everyone is hiring them, the capacity to return capital to shareholders increases.
So as the business does well, the shareholders get paid more. It feels very, very aligned.
It is highly aligned. It's a very shareholder-friendly model, especially in an industry that can be somewhat cyclical.
Okay, so let's take a step back here. We have four very, very different companies on this list: Enbridge, UnitedHealth, Pfizer, and SLB.
It's a wonderfully diverse basket.
If you were to synthesize this list, if you had to explain the core strategy connecting these four dots to a listener, how would you describe it?
I think the key phrase is diversification across economic drivers. Just look at what we've covered today.
Right.
We have infrastructure with Enbridge. That's the pipes. We have healthcare with UnitedHealth. That's the defensive insurance base. We have pharmaceuticals with Pfizer. That's the science and pipeline turnaround. And we have energy services with SLB, the drilling and momentum.
So you aren't putting all your eggs in one basket at all. You aren't betting everything on the price of oil going up or everything on healthcare regulations staying the same.
Exactly. If one sector takes a short-term hit, the others can balance it out in the portfolio. But the overarching strategy uniting all of them is the core benefit we discussed right at the very start.
The income-supported re-rating potential.
Yes. These companies provide a combination of ongoing dividend income paying you to wait and potential valuation recovery or growth.
Except maybe SLB, which is already recovering nicely.
True. But even there, the strong income component supports the valuation at those highs. And I think the main point the WealthForge source makes is what these companies are not.
What aren't they?
They are not plays relying on hypergrowth expectations.
Right. We aren't talking about a flashy tech startup that promises to change the world in 10 years, but makes literally zero money today.
Precisely. These are steady performers. They are massive businesses that make real money right now, today, and they pay a portion of that cash directly back to you.
It's really interesting to think about this from the perspective of our listener. You know, you're sitting there looking at your portfolio in 2026, and you might be feeling a bit overwhelmed by the sheer volume of noise in the market.
Oh, there is always noise,
Yeah,
but especially now.
there really is. But these four examples show how you can look for value in fundamentally different sectors. You don't have to be an expert in pipeline engineering to understand that Enbridge's toll road model works. You don't have to be a doctor to understand why UnitedHealth has sticky, recurring revenue.
And that is the true power of this kind of deep dive.
Mm,
It strips away all the complexity and the hype, and it just looks at the cash flow.
yeah.
It asks the simple questions. Is the company making money? Are they sharing it with me? And is there a logical reason to believe the underlying stock price could go up?
It's getting back to basics in the best possible way.
It really is.
Before we wrap up, I want to leave you, the listener, with a final thought to mull over. We've talked a lot about boring companies today: pipes, insurance, medicine, oil field services.
Yeah, they're not exactly cocktail party conversation starters.
Exactly. You're not going to walk up to someone and say, hey, want to hear about my regulated utility holding?
You will definitely clear the room.
But in a world, especially the world of 2026, that is so utterly obsessed with the next shiny tech object, the next AI breakthrough, the next big disruptor, there is a huge psychological hurdle in buying boring.
Oh, massive. It takes discipline. Because it goes completely against our human instinct to chase the exciting new thing.
It does. It takes real discipline to say, I'm going to buy the company that pays me 97 cents a quarter instead of the company that might, and I stress, might double in a week.
But that boredom is very often where the magic of compounding actually happens.
That is the big aha moment for me today. The powerhouse status of these four stock doesn't come from their flashiness. It comes from their reliability.
Reliability and cash flow. That is the secret sauce for long-term wealth.
Well said. And that is a wrap for our deep dive into these 4 dividend powerhouses. A big thank you to the team over at WealthForge Investing for the excellent source material.
Indeed, it was a really great stack of research to go through today.
And to you, the listener, whether you are prepping for a client meeting, managing your own retirement portfolio, or just insanely curious about where the market is moving in 2026, thanks for spending some time with us.
Stay analytical out there.
And as always, stay curious. We will catch you on the next Deep Dive.